Welcome to the Finance Podcast. The topic of this episode, Generative AI in Investment Management, with Dr. Daniel Seiler and Gabriele Susinno from CFA.
Good afternoon, and thank you for being so many to come to our seminar session today. Apologies that we didn't plan the number of seats sufficiently well, but I think it just translates the interest in our sector that we currently see in artificial intelligence in general and generative AI in particular. By way of introduction, my name is Adrian Pusch, and together with Shimon Hennel here on behalf of CFA Society Switzerland, we'll be moderating this discussion. The idea of the presentation today is that first we try to approach the question of artificial intelligence from multiple angles, multiple aspects, also hopefully the aspects that you hear a bit less about in general media. We'll hear from industry experts on this topic, and then really the value, I think, of our meeting today is in the interactions and the questions that you may have. So we'll try to budget some time towards the end so that you can ask those questions.
Thank you, Adrian. So today we have two very distinguished speakers who can give us two very different but complementary views on how AI is affecting our industry. And let me introduce them. So we have Gabriele Susinno, Ph.D., who is a senior client portfolio manager at Pictet Asset Management. Gabriele Susinno joined Pictet Asset Management in 2015. And before joining Pictet, he spent 8 years at Unigestion, where he was heading the quantitative and risk management group at the fund of hedge fund unit. Previously, he worked at Vontobel Vaudoise as head of market risk management. Gabriele started his career in finance in 1997 and gained various professional experiences working as a quantitative analyst. He holds a master's degrees in astrophysics and a Ph.D. in experimental particle physics from the University of Geneva and CERN. Also today we have Daniel Seiler, who is CEO at Eqitron AG. Daniel Seiler is the co-founder and CEO of Eqitron, an innovative startup asset manager. Prior to founding Eqitron, Daniel led Vescore, a boutique within Vontobel Asset Management, where he managed systematic and hybrid multi-asset investment solutions, overseeing nearly 50 billion at its peak with a team of 50 quant professionals. Daniel has been head of Vescore since 2009, and before he led the hedge fund platform at Swiss Capital Investment AG, overseeing investment activity across multiple funds of hedge funds. He began his career in the mid-90s as an analyst with a focus on sustainable investment. Daniel holds a Ph.D. and a master's degrees in financial and capital market theory from the University of St. Gallen, and a master's degree in environmental sciences from ETH Zurich. In addition to his professional work, Daniel teaches asset management at the University of St. Gallen. That I would like to really thank the two speakers for giving them our time today. And I want to jump straight into the topic. And I want to set a bit the background by just making it clear what are we talking about. So what is AI? And there are a few terms that we see really in the press, in the industry, and that I would like to clarify to ground the discussion. So artificial intelligence is in general the use of computers to imitate human cognitive functions. You might also have heard of machine learning, and sometimes there is a bit of ambiguity and confusion in how the terms are used. And machine learning refers to something a bit more specific, and it is the use of computers to make predictions and take decisions based on past experience, so based on data. And of course, more recently we have been talking of generative AI, which is another subset of AI. And here the aim is to use the computer to imitate human-made content, text, videos, images. And before really moving into the discussion of how all of this affects investment management, I would like to give you a bit of sense from a technology perspective of how AI, how we came to where we are today, how the field has been going. So to really understand how we came to this big disruption in 2022, which we highlight here, the main idea that I would like to convey is that to achieve artificial intelligence with a computer, you can take essentially two approaches. The first, and historically the earliest idea, which started as back as 1940s, where if you think about it, in 1940s, a computer was still using mechanical pieces to store and transform information. The original idea was for an engineer to program rules for thinking and making decisions, program all the parameters, the thresholds for decision making manually into the machine. And that's how the history started. People became very ambitious very quickly. So 1950, they were already thinking about the problem of identifying whether you are talking to a human or a computer. So this ambition grew up very quickly. And this idea of really programming explicitly patterns of thinking to the computer ran into a scalability issue. So it was simply not maintainable. And in the 70s, essentially the real world applicability was heavily criticized. And this led to a period with decreased funding, which is usually called the first AI winter. So the alternative of just really explicitly defining the rules to take decisions is to define rules for a computer to learn from data, find patterns, learn from past experiences. You teach the machine to learn, and then the machine teaches itself to take decisions. This is called machine learning, and the concept is already quite old. It was introduced in 1959. The problem at the time was that this requires a lot of computation, and the computers back then were not even close to being sufficient to realize the idea at scale. So there was a period with essentially all the ideas, the ambition, but a lack of computing power. A short-lived attempt to focus those rule-based systems on specific applications in specific domains, take a step back from really trying to imitate full human intelligence, but this also failed to scale and failed to be maintained at scales, leading to another period of underinvestment in the winter. And then finally, say that the current phase of optimism originates in the late 80s and the 90s, where there were a few advances that, on the one side, led the mathematical groundwork for building large systems imitating human neurons, and also more task-oriented ideas in this machine learning space. So slowly the machine learning idea of training the machine to extract patterns from data came into the real world of practical applications. And of course, at the same time, we also had a continuous increase in computing power, essentially a continuous exponential process of computers becoming more performant. And then the first high-profile success stories came about. You might remember IBM Deep Blue, which defended the world chess champion at the time. In 2012, DeepMind identified cats in videos. That was really one of the first applications that caught the attention of the general public. And all of this, really this acceleration that we saw in the last decades, it was due to availability of computer power. So NVIDIA introduced a new architecture which really made sufficient computing power available at scale. And of course, the recent history that I guess we are all very, very mindful of is comes from this idea in 2017, where DeepMind, in the meanwhile acquired by Google, issued this idea of the attention mechanism that you might have heard about in the press, that led to the transformer architecture and enabled generative AI, so enabled using really computer to generate content. And then very quickly, models based on this idea were built up, and in 2022, released to the general public as a chatbot service. And I think for most of us, 2022 really marked a disruption. It was really like there's a time before and a time after for general public. And that's where we come to the point of asking that how is it for finance and the investment management profession? And with that, I would like to give the floor to our speakers to really bring this timeline into the context of our profession. Maybe let me start with Gabriele.
Yeah, okay.
From the point of view of just predicting asset returns, predicting equity returns, did you live through a disruption in 2022?
No, not in 2022, because we started thinking about using AI back in 2016 and trying to identify what were the most appropriate approaches to be applied to the financial field, both in terms of improving the decision-making process, but also in terms of improving how portfolios, traditional long-only portfolio, may be implemented if you chase a long-term alpha. And out of it, you start quickly to realize that what matters on the short term are a number of features that characterize the market activity day by day, the market depth, volumes, and many other characteristics that cannot be just based on fundamentals and factors. And so you need to enlarge the spectrum of information you need and have the adequate instruments and algorithms to address the problem you have. And then we started trying neural networks, gradient-boosted machines, and others, until the point we reach an idea that those instruments can both help to improve the decision-making process, but also can open a new door for a new family of investment strategies. And by the way, we were ready to use our understanding, having started that from 2016 to date, by 2021, where we published our article in Journal in Finance and Data Science on how to do performance attribution on machine learning and artificial intelligence models. So then we profited from the release in 2022 of ChatGPT, because I'm pretty sure that if we were to give a talk on how to invest in AI in 2021, we will have had a much smaller audience in this room. And you would have considered us as a mad rocket scientist and considered that in around the years 20, there were a lot of pretended hedge funds using neural networks, and no one has survived today. But today is another story, and I'm very pleased that the power of AI is generalizing to everyone, but we need now to understand everyone, no matter the level of technicalities, how to use it, how to confront ourselves with the instruments. You may want to have an instrument that selects stocks and make a strategy. There are limitations if you delegate that to an algorithm, and it's better if you supervise it and you understand from where the performance comes from. You may want also to make a more efficient yourself by being able to grasp larger amount of text, data, and information, and being able to condense that in a more practical manner. But take care, if you are a lawyer, a Swiss lawyer, and you want to ask a GPT what are the federal tribunal sentences that are directly to your case, this is the best way of making GPT hallucinate. It's not good at all to associate concepts and references, so you need to understand how to use it, because risks are everywhere and opportunities also. But like always, new tools comes with the need of new competencies.
So Gabriele, then what we hear is that Gen AI is like one more tool in the toolbox offered by AI in general for the investment profession. But can we make a case that there's something more fundamental about the generative AI? Maybe
to invest?
To invest. I mean, to blur the lines between fundamental, quantitative.
We tried, and I just conclude, we tried generative AI just to select stocks, not to improve the decision-making process to select stocks. And obviously, if you have a RAG, which is a a retrieval augmented GPT, so it goes also on what's in the internet, and you ask to give you the best opportunities. Pretty much, if you do not intervene, you have a momentum strategy, and you don't need the GPT to do a momentum strategy. Then, if you want to look if it improves your decision-making process, then there is a lot of space of doing this.
Thank you. Daniel, how did you live this timeline?
I think, the perspective we just heard is a perspective of an asset manager. It's not the perspective of a client. Yeah. And moreover, it's the perspective of a portfolio manager.
Absolutely.
So the question here is to improve the decision making, and you can debate about that. if you can really make better decisions with AI, because if there is nothing to predict, or there is nothing to predict, and the growth of index funds actually showed there is nothing much to predict. However, from another industry perspective, clearly 2022 marks a massive disruption, right? Because think about it. The first, maybe Shimon, you can quickly go back to the definitions, right? It's basically to imitate human cognitive functions, and along the investment process, there are a lot of humans there. And from an asset manager point of view, every human is a lot of cost, and so if you have the ability to kind of change this cost to a lower cost, then that's interesting. And clearly, therefore, I think 2022 is really disruptive, and that's why we also founded our company. Clearly, we are also investors, we are portfolio managers, but I see more than just better decision making. I see really to get rid of a lot of cost along the value chain. And think about what happens then if you would be able to get rid of the cost. What happens then? Probably investment products get cheaper. Right? And if the investment products get cheaper, people will start to think about whether they want to invest in passive or not, if you have a certain alpha. But where does it stop, right? Where does it stop? Where or how? What is the impact then of AI overall? So, how did we live through this time? We open up a new company focusing on that, on generative AI.
But maybe on this point, because you discussed also, that maybe fewer human resources will be needed. I think it opens a discussion that we also have seen in the media, not necessarily on asset management, but on artificial intelligence in general, which is, are the barriers to entry higher or lower? Because I think looking at the entire ecosystem, right, we have been fed throughout 2024, first with information that all the Magnificent Seven were investing billions because everyone had to have hundreds of data centers and those expensive NVIDIA chips on one hand. Then there was DeepSeek, and people started asking questions, are those high investments necessary? How does it apply to investment management from both of your perspectives? Are the barriers to entry, you think, lower because, as you say, many things can be automated maybe? Or are the barriers to entry higher because to have a performing AI model, actually, you need to train them on those very expensive chips, for example?
I mean, basically,
please.
The value chain is, is a chain. So you look at the individual steps, and clearly we don't need to reinvent the rules or the wheel. We are end users, right? And if you look at DeepSeek, there is rumors that they couldn't do that from the get-go. They needed first OpenAI to do that, to train their models. And clearly, we do not need to do the heavy lifting. At this moment, what stands between basically an automated investment process and the client is the security issue of the banks and asset managers, because they're client data and you want to be very careful. But overall, let's be honest, that's going to happen, right? We just signed, or we just have the first mandate to a fully automated Gen CIO service in the fixed income space, producing an outlook fully systematized in 4.5 minutes. It's a 50 pages PowerPoint. Most of the CIOs even cannot open the PowerPoint, honestly.
So where do you see the value? Is it, we heard, better stock selection, better asset selection, better portfolio construction? On the other side, more the cost-cutting aspect, streamlining operations. Is there a side to this balance which is more important in your perspective?
As we use AI to invest, I may eventually give you the complementary view of the very rightful one that has been provided now. When you invest, then you want to understand why you invest. You will never invest in a black box. We had people investing in black box in the past, and we see what is the impact. So even from an investment manager perspective, you need to understand what is the cause that generates the portfolio today the way it is. And ex post, you want to be able to explain from where the performances were coming from. And this requires a sort of barrier to entry, because either you use AI like some may do to claim that they use AI to aggregate things, but it counts for 10% of their portfolio, or you do what we do in our enhanced index series, in which we use AI to fully invest. But we need to understand from where performances come from and understand how to attribute performances. And now to come to the fact of the indices and passive investment. One thing that we have realized over those years we were developing the strategy is that if you use AI to predict total returns of a stock, so let's say today I want to have the best prediction of the next month return of a stock and do it for all the stocks of the MSCI World, and then build a portfolio out of it. Then as a benchmark, you should use the most refined traditional econometric approach. And then you want to see if using a more complex approach enables you to constantly and systematically having superior return. And by trying different algorithms and different approaches for years, and this is the chance of where we work, we can take the risk of studying a bit more. We were unable to have consistently higher returns than the traditional indices, and that it goes in your direction. To the point where we start to understand that AI was nothing else than a more complex way of capturing the factors or the risk premia we are all aware of, all those beta to value, growth, size, region, country, sectors, whatever. And it was doing it pretty much in the same linear way of traditional econometric model, but we were using a much complex box of stuff. So there is no interest in that. To the day, and this was 2019, 2018, we thought, okay, but if we are observing something where traditional factors dominate, the linear ones, remove them and just look at the specific returns. And maybe there, those complexity of the data may explain what we were always throwing away, the dirty water and the baby. And maybe there is something in what we call residual, idiosyncratic return, specific return, what else. So those returns are how people act together on a specific company. So you may act on semiconductors because everyone talking about AI, and so there is the semiconductor team moving all the companies. Remove that. Then you have the growth, because they are highly growing companies, and the growth team that remove that. So remove all the known factors, remain just with idiosyncratic specific returns. Try to predict those. And there we started to have superior results from the model, consistently to the point that we are now able to launch an enhanced index in which you need to require a little additional tracking error than a traditional tracker. But consistently, AI is bringing something new in the table that what traditional linear models were not able to. But you cannot do it without building the infrastructure, building the model, learning the model, understanding the model, understand why the model works the way it works, and being able to attribute performances. So it's still a quite high barrier to entry.
And Gabriele, so you mentioned this idea of transparency, right? With traditional econometrics, we might have superior return, but it's a bit of a black box. And what the materials that we're going to provide show this idea of really decomposing the alpha sources, looking into what is behind. Can you tell us on an intuitive level, why can AI achieve this? Like, for a non-technical audience.
because maybe if you take just the slide before, just to characterize what is the AI we are using. We are using a forest of decision trees. The decision trees is how we make decisions ourselves. We have a complex set of data. So we start from the news. Then if something is true, we start looking into some other factors. Then we go on the balance sheet and we select an item, we aggregate them, and then at the end, we make a decision. So our way of acting is behaving as a decision tree. But this is something that can be systematized in a computer.
So you gather information, analyze it.
Yes, indeed.
That's
absolutely right.
In real life.
You're following. Great. So what you can put in a computer is an analyst, materialized in, modeled as a decision tree. Out of 300, 400 features that can stem from fundamental data to sentiment to the full database of IBES analysis, the full database of credit card transaction, but you have a choice before, and you let the freedom to choose. To do what? Predict the next month's specific return of every single stock. So sometimes it's right, more often it's wrong. What you do? Hire a second analyst and ask him, look at the first and try to correct his faults in order that you two together are much stronger than you two alone. And then you have a fairly nicer result. Then you hire a third, a fourth, a fifth, sixth. We have hired 50,000 analysts working coherently together. To do what? To have the most robust prediction of next month's specific returns. And based on short-term data with short-lived signals, the time life of those expectations is like market memory, 16 days. After 1 month, you just forgot what happened 1 month ago. We have a short memory, so the lifetime of those signals are very short. And then you can use those signals of expectation of specific returns based on some more exotic data than the traditional one to extract a little value out of the prediction that enable us to generate an enhanced index that has exactly the same risk characteristics that the benchmark, but bringing home 1.5 to 2% excess return annualized, which contradict the traditional economic theory. And this is something that has to be studied. Either we opened a new door, or there is a risk factor that no one has yet formalized. And those two doors have equal probabilities, but the fact that the stuff is working.
So we heard short-term signals exploiting inefficiencies. This is a quant investor mindset, but done better with AI. Mm-hmm. And I would like to also hear a bit from you. On the other side, we have fundamental approaches, right? And this is more, it's not short-term signals, it's more of a long-term understanding. How does AI enter the picture here? And what problem does it help us solve? Daniel, please, you were kind to share some materials.
So I think I tried to explain this crystal ball to my mother as well, since I did that before. And it was very difficult. All these terms you don't really understand and very technical. And I'm very sure that the typical advisor cannot use that. So this is, how can you use that in an industry? And that was actually at the beginning our question: how can we use something like AI in a language which everyone can understand, which you can understand as an advisor? And basically, the best place to start is with stories. Everyone likes stories, We probably think even in stories, and that's why we focused at the beginning only on thematic investing. And thematic investing is very nice because you can tell stories. I told my mother, for example, electric vehicle is a very good thing. You need to invest in the future. Soon everyone will drive an electric vehicle. And clearly, then she understood. She's not talking about idiosyncratic, links, rechts, forest. Well, it's very difficult to understand. So thematic is the place to start. The problem is that next slide, the thematic always underperforms. And this is a study from a financial, the review of financial studies. Over 5 years, the thematic indices underperformed in the US, and this is the average, underperformed 30%. I'm actually curious how you will then work with your colleagues in the thematic mega fund of Pictet as well. So basically, 30% underperformance over 5 years, and clearly you see before launch, when there was a launch date at 0, before launch, the themes, they actually worked quite well. So it looks to me somehow that the timing is a little bit off. And we wanted to solve this timing. So how do you solve this timing? First, you have to understand what is a theme. And there we used the semantic capabilities of generative AI. So we screen around 50,000 news articles a month from 200 sources. And the good thing is you could do it multilingual if you would be a bigger company and you would have more funding. But at the moment, we restrict from that. So basically, we screen the whole news flow and we try to understand which themes are currently en vogue, which get the biggest investor attention. And in doing so, we can solve this structural issue. And I agree clearly that certain structural issues are problematic for index investments, and you can use them to outperform. And we try here basically to do a similar thing, just with AI. We use more, simple. We use more data. We use it faster, and clearly this is very helpful to produce then at the end an alpha. Nevertheless, what this approach can do, it can tell a story. So think about the value chain of the whole asset management industry. If you are sitting in front of the client, you want to tell a story he can understand. You don't want to talk about idiosyncratic forests. You want to say, hey, listen, digital healthcare services, the new thing. You really should invest. And that's what this approach allows. Basically, because we get a good thinking of the landscape. So it's more, clearly we do that systematically as well, but you can think of having this as a co-pilot. And I think that's probably also an interesting question. How are we going to work in the industry with AI? Are we having a co-pilot at the end? Everyone for every job? And I think that's the interesting bit for the industry point of view, not only portfolio management point of view.
May I ask a question? I have two things. First of all, a precision. At Pictet, thematic investment are extremely good to invest in AI. Investing with AI is a different business. So we can live together doing two concurrent things. And I have a question for the audience. Who do not understand the term idiosyncratic? Idiosyncratic means how people act on a specific company, not thinking about others. They just want to know if they want to invest or not in NVIDIA, then forget all the others. And you need to materialize this collective action of many people looking at NVIDIA, forgetting all the rest, just thinking if they want or don't want. And forgetting eventually from what their friends tells them, because they have to take a decision. A decision is our own way of acting, and this is never available in any model, whatever you do. It's a sort, people consider that noise. Instead, there is signaling that you can use.
Thank you. But then the perspective, if I may summarize it, enhanced indexing is not new, but now with AI we can really do it well, right? Thematic investing is not new, but with AI we can get it right. So it's really, may I propose that there's no disruption really in how the industry works, how the products are built, but the quality increases.
Yeah. I tend to disagree, but
that's what I wanted to hear.
So think about when you started to work, which tool did you use? Excel, right? And Excel is the most powerful tool in finance. I mean, it's the tool which is used in finance. And clearly, when we started working, the first formula you put in, and then you could really understand what you can do with this Excel sheet. This is a great thing. And just started a new class at the University of Constance. It's called the Asset Management and Technology. And we built bots there. We built single bots with the students. And bots analyzing the reports, the annual reports, analyzing income statements and so forth. So this will be the next generation of people hired at the asset management industry. And they will come with a co-pilot. And they will be more efficient. And you need to hire less. And you can come down with the cost.
Maybe on this point, because there were two studies that maybe you have read about. First was, I think it was one of the consultancies, and I think Harvard Business Review, it was in management consulting, not in finance, but they compared slow consultants and smart consultants, and some of them, they gave them, ChatGPT, and some of them had to work like they did. And the results, if I just summarize quickly, were that ChatGPT was bringing the slow consultants back to like average plus. So basically the gap between a good consultant or like good employee and a bad employee was smaller. It didn't necessarily make the brilliant consultants even better. It just, it made the slow ones faster. So there was one study. And then the other thing, but that's more in Financial Times, there was this article saying that, for example, now everyone is, since the barrier to entry is lower to, for example, do sentiment analysis on quarterly calls with the management boards, those people in large companies, they get trained, right? If we know it, they know it. And so the overall sentiment of those announcements gets better overall. So basically there's less information because it's less of actual free speech. It's just a script that has been optimized for artificial intelligence. So these two examples, but maybe just to open discussion, what stands, it's speculative, what's coming next? So can we say that if, Gabriele is trying to outsmart the market on a daily basis, you, Daniel, you're trying to outsmart the markets on a daily basis, probably yourselves as well. If we all get the tools, will there be lower alpha? Will we be a bit more efficient, but just reaching a new plateau? Or other niches? Will those algorithms allow us to have specific alpha that we can deliver, for example, for our clients?
So I can tell you what theory says, right? So there is this famous paper of Grossman-Stiglitz, which basically links the alpha of what we can produce to the cost of the alpha. And think about if the cost gets lower, the alpha gets lower. And this is a general equilibrium model.
And then from the general equilibrium, I have to intervene a little bit on non-equilibrium, in systems that are not in equilibrium, like our all-day life. Equilibriums are very unstable in the market by looking at them. And actually, what the AI may uncover, you know how many parameters you have when you use GPT-4? Almost 5 trillion. And then, have you ever played with a model in economy that have 5 trillion parameters? We always tend to minimize them, have the best compromise. Yes?
I have a question on this one. So what you try to do is to explain the residual or a noise. And then based on your experience, have you been able to attribute that to existing traditional factors, or you've been able to identify some new risks that the market is
something new?
The second part to this question is that obviously it's not just streamline economics, right? There has been a big trend or big developments in behavioral economics, which goes beyond traditional ones. And part of what you explained could come from behavioral economics.
You have 100% view of what we think is the origin. If you can go back one slide, 2, there. So if, first and foremost, we think we are harvesting short-term behavioral biases of many people interacting together to drive the value of a company. They interact in many different manners. We just focus on those subset of things that just refer to a specific company, not understanding what the company's peers are doing. You remove that, just how the company moves. But then if you look ex post, what are the different entities that contribute to the alpha that you are extracting time after time? Half of it comes from linear systems for which you do not need artificial intelligence. As you know, what statistical arbitrage are we using? Price reversals, short-term momentums, statistical arbitrage on daily moves, they're pretty much what explain 50% of the alpha. And this 50% can be positive, negative, can oscillate. Then you have a sort of residual of 20% of the alpha that comes from exposure to, again, linear, traditional, more fundamental factors like risk mispricing, again, related to local behavioral things. I have the impression of looking at the price of Pharma, Seiler, and Hansen. You have those two concurrent things. But then, if you were to use only traditional methods, this part of the donut would have made 100%. What we have seen, I may say, quote-unquote, discovered, that we have an additional 30% that is poorly related to the AI we use. And actually, what it's doing, it may seem that we have 30% black box in the alpha. No, actually, we do performance attribution within also this 30%. And what you show is that you are much more efficient than a human being or a traditional modeler in modeling how the 300, 400 features you use interact each other at every single scale of time. When you use volatility, what you do? You want to use annualized volatility in our models to characterize the risk. But if you use yearly data, you have few data points, and so it's a very unstable quantity. Then what you can do, you take daily volatility, so you make the standard deviation of the price variation on a day, and you multiply that by a factor to annualize it. And then you destroy information, because you destroy the richness on how one price variation in a day affects the other days. Likewise, this may affect other factors that enters into play with the objective to predict something. So this is an efficient way of exploiting the richness within the data without being obliged to filter out things and cast them on what we had as traditional models. And so you give to the AI or to the 50,000 analysts that cooperates together uncurated data. And out of that, they may choose calibration after calibration to adapt. And obviously, you need to avoid overfitting, but this will be open another chapter. But what your question is, behavioral biases are inherently on this 30%, and they are often short-term, like pharma. Short-term market, excess short-term volatility, and Seiler price converge to the fundamentals, which are the factors.
Of information.
Sorry?
Potentially availability of information, which may feed your argument as well.
Potential?
Availability or asymmetry of information.
Potentially, but there is another thing. The model is very complex. And probably what we are harvesting here is a minimum fraction of what is available. So if I give the same model, the same information, the same quality of the information to someone else, he will probably advise something else, but also in the same direction. So what we bring home is something that is brand new, is not considered in all theories. It's something that has to be addressed from a sort of engineer physicist mindset rather than a traditional equilibrium.
We're also aware of time, so I know if there are any other, maybe one last questions, and then we can wrap up and we can continue the discussions offline, in the corridors of the of the Halle. And if not?
If not, let's maybe close on a final note shortly. What will change for investors?
It will be a better life going forward.
I might just conclude with a sentence. We talk about Excel. Accountants were scared to disappear with Excel. So the Excel, you don't need an accountant anymore. And then the world has given very good augmented accountants with Excel, and those who have not adopted Excel eventually disappeared. Today is a great opportunity. Opportunities requires knowledge and understanding, but please try to get augmented by the new opportunities that are given to us.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory.